Hey guys, Toby Mathis here, and today we're going to talk about the effect of inflation on your investments. And so I'm going to do kind of broad categories. I think it was Ray Dalio that once said that there's really two major growth, things that move the markets, and that is inflation and growth. The ability to develop and have a wider market, and this thing called inflation. What is inflation? More people running around trying to buy fewer things. And so if you think about it, what occurred over the last 10 years in our economy is we had a Federal Reserve put in about, what is it, $8-9 trillion of liquidity into the market, which means like they printed a ton of cash, pulled it out of air and used it to buy mortgages, basically. And it's kind of what you call the mortgage-backed securities. They take all the mortgages and they sell them. And so that's what they were buying. They were putting a ton of liquidity into the marketplace, which means there's more dollars. Add to the fact that we had this pandemic and pandemic relief where we're handing out cash, and it's no surprise that there's inflation. Anybody who was paying attention to it, we all pretty much said, like you can go back and watch videos from a couple of years ago, we're all saying, hey, when you're creating this much cash, it just means now there's the people that have cash, your cash is worth less. So if I had $100, no matter what the situation was, if I had a certain percentage of the total dollars in the world, which was represented by my $100 versus the entire monetary supply, and if we just injected and said, hey, we're going to add a bunch more money, my percentage goes down. It's kind of like diluting stock. Hey, I could have 3 shares of ABC Corporation when there's only 1,000 shares. Hey, that's decent. But now if there's 1,000,000 shares and I still have only 3 shares, you just devalued my interest. That's all that happened, so that we don't have to overthink it. So when we look at what does inflation drive, it's going to make things obviously more expensive, like energy. Our CPI is using a number of 5% year over year growth of real estate, for example. Um, and we know that it's 20 to 30% higher. Like in the last 2 years in my neighborhood in Vegas, you're talking about growth in some cases of 50-60% on the equity of the value of homes, and we saw 30% to 40% growth on rents. As long as those numbers are staying somewhat consistent, we're not going to have an overheated market. There's several things that come into play there, by the way. A, how much supply is there? Do we have enough housing for everybody? Here's a hint, we don't. So there's not enough supply. How do we know there's not enough supply? Because we're below seasonal norms. We're below the average norms consistently for this last year, year and a half. We just haven't had enough supply. We're looking at somewhere 2 to 3 million units shy of where we need to be, and that's about how much falls out every year is 1.7 million. So we have to be bringing into fruition 1.7 homes, either rehabbing them or building new houses or whatnot, and we're barely keeping up with it, which means it's not getting better, which means housing prices, the demand is going to continue to be more than what there is supply, which is going to continue to push things up. What could bring it down? Again, how do you combat inflation? Econ 101 is you make it more expensive to get money. So people have less access to cash. The credit gets more expensive. When the Fed is out there giving money away at 0 basis points to 50 basis points, you had these big Wall Street institutions getting really cheap money, going out buying everything, and people were looking like, hey, I got sub 3% mortgage. You're still paying twice as much as the institutions. Like, institution decided to go compete with you and even make more pressure on the markets and cause prices to go up even higher. So as interest rates go up, that's going to put gravity onto the situation. The reason I say gravity is because Warren Buffett once said that inflation rates are to the markets what gravity is to matter. There's something very similar to that, not a direct quote. But he just meant that it pushes down. So if you have a company that's high flying, but they're not making money, their fundamentals aren't great, they might, because money's cheap and they can get all this cash and they can enter into this marketplace, they seem like a high flyer. That's your growth stocks. So once the interest rates start going up to combat inflation, so here goes inflation, here go interest rates, try to combat it, boom, growth stocks get hammered. Everybody could see it. anybody that was looking at the numbers knew that that was going to be something that happens. And we're saying, get in with good companies. I've always said this, like if you're in a high inflationary cycle, expect the increased interest rates. When there's higher interest rates, you want good, strong companies, because all interest rates are is basically saying if you need credit, it's going to cost you more. So for example, if you're a cash buyer for a house, it doesn't matter. But if you need to borrow money for a house, your affordability of a home just got worse as interest rates go up. And to put it in real terms, the cost of a house, let's say a $500,000 house, you're putting 20% down, so $400,000 note. The payment on that $400,000 note has roughly doubled in the last 6 months. So it's less affordable. The problem is you have so much cash chasing all these houses. You still have massive demand. Eventually, it'll work itself out. Eventually, as home prices are going up, rents are going up. Here's what happened in 2000. I'll actually draw it up because you kind of want to see the ratio. The ratio of the value of the house went way up here to like 1.6, which was the value of the home, the median value of a house versus its rent equivalent. And so you see these things, as long as the rents are going up, and even with the house is going up, so like everything's increasing 20% a year, you could do that indefinitely. But if you have this goes up 20% and the rents go up 10%, all of a sudden you start having this peak. Because the rental value of that property, if I wasn't going to buy it and stay in it, I have to rent it to somebody, it's not going to pay for itself. I'm overpaying for houses. And where are we at right now? This was about 2005, 2006 is probably where we hit that peak. So we could see it. We're still down right about 1.4. And the reason that we're there, I shouldn't put that other side to it because we're just right here. We're slowly eking up. But as long as rents are consistently following the prices, it could do it indefinitely. What I look at is when that ratio starts to get too out of whack, like when we get into the 1.5, 1.6, expect that the market's overheated. People are overpaying for homes because they couldn't rent it. So there's not enough demand. So what happened in 2007 when we just got crushed is we had a lot of vacancies. Nobody wanted to be in them. There wasn't a rental market to support it. So if you went and bought 3 speculative homes, hey, I'm going to be the next real estate tycoon, and you bought those houses, you couldn't rent them and for the rent equivalent. You way overpaid, so you couldn't justify the price based off the rents. That hasn't happened yet, guys. We're not there. So what does that mean for the real estate market? The real estate market's going to stay solid. As long as inflation is going up and it's affecting the house prices at the same rate as it's affecting the rents, we could do this indefinitely. We're going to be fine. Because there's not enough inventory. It's going to take, I would guess, and nobody has a crystal ball, so I'm going to put a big disclaimer on this, but I think it's going to take probably 2 years before we see any meaningful either downturn or it's going to be completely evened out. You might see it slow down in growth to not be 20% year over year, right? Maybe it'll be 5%, but I don't think you're going to see it turn the other direction and start going down because there's too much demand. Barring some catastrophic, like the economy just goes bonk. Like, I don't think we're there. I don't see that happening. But unless something catastrophic occurred, like there's World War III that's beyond just the Ukraine and Russia stuff, that there's something more that's going on that's causing an issue. Just on the forces that we're at right now, just the economics of it, I don't think that we're going to stop. Now, that said, the Fed is still raising interest rates. So that's going to have an impact on affordability, and that could cause a little bit of I think the number's going to come down because what it's going to do is cut some of the top of the market. So the median's going to be kind of somewhere in the middle, and it's going to push that down. But like right now, I believe that we're over 500,000, and your rent rents are up 30% over the last 2 years. Like it's bonkers. I don't see it coming back. Now, if they raise interest rates and they start to push that down, I guess there's nothing that's beyond possibility, but I still don't see it. Like we still are underbuilt. Give me a year, give me 2 years of lots of people trying to build, and we don't have supply chain issues, and we're able to get modular homes. Like we've ordered modular homes that take 6 months to 9 months to get. Everybody's in that same boat. Everybody's trying to find materials to build. Even if you have the materials, you don't have the labor. It's tough. So we're building about as fast as we can, and it's keeping it caught up with how many properties are falling out every year, houses that are retired, torn down, dilapidated, inhabitable. There's about 1.7 million a year that just fall out, and we're not really replacing that number. We need to make up, I would guesstimate, somewhere around 3 million units before we're there. Now, that said, I'm just a tax attorney. All I could do is read the tea leaves and read the economic reports. There's still no inventory. Vacancy rates are really, really low. In my town, you can't find a property. You go in there, and the property manager are all saying the same thing. They'll get 20 applications for a rental, and I'm in Las Vegas, so that may be different in your town, but there's a lot of places reporting that type of activity, which is just going to keep pushing those prices on up. Other thing that you look at is the market. So the stock market, like I said, we have the increased cost of money is going to have an adverse impact on companies that are not profitable and are burning through cash and are relying on credit. So if they're needing to go out there and get money, what you're going to see, and I guarantee this is going to be the case, I'm not looking at the stats, but my guess is you're not seeing a lot of companies going public this year. You're not seeing a lot of companies raising money in private financing. It doesn't mean it's non-existent. It just means it's really hard. And it's kind of like the dot-com days, whenever anybody with a pulse, you have a website, people would throw money at it. Now it's being very, very frugal. It's just not going to happen. So you're going to see a tightening in the market because money is now more expensive. If you're a company like, I always look at Coca-Cola, 3M, Procter & Gamble, what other ones would be good ones? Lowe's, Home Depot, even your companies like a Verizon, Exxon, Chevron, some of these, I don't see them getting creamed in this market. They might get caught up in the sell-off a little bit, but over time, these companies, that dividend yield is strong. They're profitable companies. They pay out those profits. They're consistently profitable. Even if they pull back a little bit and they say, hey, supply chain issues or money's more expensive, people are spending less because they don't have as much money. It was great during the pandemic. Everybody got checks and they were spending it freely, but now they're going into their credit and they're not going to be as free to spend. I get that. But it doesn't mean the company's not profitable any longer. It means companies that have a good moat built around their brand, like a Coca-Cola, people are still going to go out there and get it. It doesn't matter. Did the price go up 10%? Okay, so my soda is $1.10 instead of $1. It's not going to matter. They're still going to sell their soda. They're still going to make their profit margin. It's not going to have that big of an impact. Are people going to stop buying iPhones? No. Still going to happen. So there's companies like that are solid, that are going to continue to do just fine. And here's the truth of the matter is that when we have a pullback in the market, I believe we're probably in a twice, 3 time in a lifetime opportunity in the marketplace. You've had a pullback with the S&P, unlike, it's probably less than 5 times in history have we seen this type of pullback. I haven't looked at the numbers today, but I would say we're probably in the neighborhood of the 4th farthest pullback we've ever had at the beginning of a year, between January and May, and that it's every single situation. By the end of the year, you were up double digits. So I think you're sitting on a great opportunity to look at solid companies. Now, I'm not a financial advisor. I'm just a tax attorney, but I could just say from my clients, watching successful clients year over year, what do? They continuously buy solid companies. They don't go chasing. If they are gambling, they're deliberately gambling, saying, hey, I'll put some money into speculative stocks because I like the technology or I'm interested in that company, knowing that it's a gamble and they're willing to lose. But for the most part, they're in real estate and they're in solid equities. The other reason this is good, and you may or may not realize this, is that you can still use those assets to pull money back. A lot of those are tied to index. So for example, you may have a prime plus 1.5% or something like that. And so the money goes up if you have to use it. But then when that money starts going down, you have free access to it as well. It just means that you have some liquidity to go into some of these things where you're saying, hey, right now inflation's 8%. So I know if I just sit on my cash, it's going negative. So my dollar's going to be worth 92 cents at the end of the year. I'm not going to put it in a savings account because that's what, 0.5. It's going to give me 0.5%. So I'm going to lose 7.5 or 8% by the end of the year with inflation. So I'm going to have to put it in something. And that's what most investors start doing is they're saying, hey, I can make nice returns. Even if they're paying 5% on that money instead of 3%, they'll still say, I'm going to make nice returns. And they don't have to sell their underlying asset to do it. I see it over and over and over again. Hey, I see great real estate opportunities. They're borrowing against their stocks. And people go, you can't do that. It's a security-backed line of credit. It wasn't that long ago that those were sub 2%. Even on a locked one, they're still around 4 or 5%. Even if, depending on which brokerage house you go to, you can get that money pretty inexpensively. And then you take it and you go buy something that's going to go crazy. Like right now, real estate again, still going up. I don't think it's going to stop. I don't think it's going to go into loss territory at all. But I think that if anything, it's just going to keep on its kind of a current trajectory, maybe start to level out, but it's still going to be nice increases. And if you're using it for cash flow, it's even better. Frankly, good investors don't care what the value of their stock portfolio is unless they're going to borrow against it. What they care about, on their rental portfolio, when they have, well, even their stocks, really good investors are living off of the income that's being provided off the stock, or they're renting out using covered calls and they're getting all that extra money, but they don't really worry about the value of their stock. Real estate investors tend to not care so much about the value of their real estate. What they care about is, can I use it as leverage to get more real estate? But what they care about is that cash flow. If I have $1 million of property or $2 million of property, it matters not if I'm making $100,000 a year in positive cash flow, right? It doesn't really matter. Sometimes you're looking at it saying, am I getting a big enough return? Do I want to trade it for something else? But it really, to me, doesn't make that big of a difference. A lot of times you're looking at it saying, I'm not going to worry about the value of my portfolio, because if I start looking at values, I might do something emotional. In other words, right now we've had the market run up and you could sell a house. We have folks in my town where their houses have doubled and they go out and they're like, I'm going to sell it. And then they sell it. And then they're like, oh crap, I can't find another house. Everything's gone up twice as much. Yep. So unless you're going to move to a cheaper neighborhood or you're going to move out of state or go someplace else, everywhere prices are up. You've seen it all over the country. They're up 20% nationwide year over year. That's an average. It might be worse in your neighborhood. It might be better in your neighborhood. But I'm telling you, if you're going from like an Austin where you've had massive growth to a Las Vegas, it's not necessarily going to be cheaper. Or all these people in my town, they come from California a lot, where they sell their houses, where they have these big profits, and they come in here and they're going to buy a house because it's cheaper. And what they've done is the prices have been driven up now. A lot of neighborhoods, they're twice as much as they were just a year ago, because you have so much cash coming in. And these people are like, hey, it was so much more expensive on the coast and I could buy, they don't care. They're going to overbid. They're going to bid $100,000, $200,000 over asking on a really nice house or something like that. It's just crazy what you see. So I don't see that going away. So going all full circle, you have inflation, which drives your values higher. Everything gets driven higher. What's pushing them down is interest rates, because it's designed to squish down and slow down inflation. Until that happens, you're going to see this market in this muddled area where it's schizophrenic, going crazy, up, down. It's all sorts of volatility, right? Until they see that working, we're going to say, oh my God, inflation's going up 8%, 8.5%. Hint, if we use the old CPI number from 1982, what they always compare it to, inflation hasn't been this bad since the 80s. Well, under the 80s calculation, we'd be closer to 16%, because we've dumped a bunch of cash into the system, right? Inflation went bonkers. So we're trying to combat it. It's not going to stop. We're going to keep seeing that. But what you should know is that real estate and security is still a great place. It's still a It's an investor's game right now. In fact, it's the best investors. This is what you love. You love it when things are on sale. And there's been madness in the market, massive drops, great values. Like you're just seeing companies that I use Zoom. Zoom was selling at some ridiculous multiple of its sales at the beginning of the pandemic, and now it's like 7 times sales. Like Netflix is another one. Their sales go up, but they get creamed, right? They were just too high flying, and they needed to come back down to earth. I'm not saying to go buy those, but I'm just saying is that you look at it now, and they're financially healthier than when their valuations were much higher, which is kind of it seems counterintuitive. So this is a good time for you to go out and buy really good, solid companies that are going to pay you. They'll pay for themselves over a long enough horizon. If you're getting a company that's at a 5% dividend yield, it'll pay for itself in 20 years, right? It's going to buy itself. So you're out nothing, and you'll just have an income stream for the next 100, 200 years for your family. That's one of the ways to look at it. If you're looking at real estate, you can go out there and get into real estate. There's a heavy demand for it. It's not going away. You're always going to have a pretty high demand, and you're looking at it saying, hey, I'm going to get rents, and the rents are continuing to go up. Inflation drives it up too. So there's still opportunities out there for folks, and I wish you well as you go out there and take advantage of them. Hey guys, if you like this type of information, please click the like button, subscribe, and better yet, share it with somebody who might benefit from this. And the other thing is, if you have specific topics you want us to hit, please go into the comment section and let us know what topic you'd like to see us discuss.